Welcome to this deep dive into the structural analysis and fundamental valuation of the gold mining sector. As we navigate the financial landscape of early 2026, the precious metals market has undergone a historic shift. Gold has shattered previous technical and psychological barriers, establishing a new paradigm above the $5,000 per ounce mark. This surge has forced a complete re-evaluation of the Eck Gold Miners ETF, known by its ticker GDX. We are currently analyzing the windfall profits reported by mining companies in their latest fiscal year results, which were released between November 2025 and February 2026. The central question is whether current ETF valuations adequately reflect the massive free cash flow generation capacity of the underlying assets. The core thesis emerging from recent data is that the gold mining sector is in the early stages of a fundamental re-rating. We are witnessing a historic disconnection between the price of the physical metal and the valuation of the companies that produce it. While gold has appreciated significantly over the past year, driven by sovereign purchases and geopolitical instability, mining stocks within the GDX are still trading at valuation multiples that represent a significant discount compared to previous bull cycles. A bottom-up analysis of the top 10 components of the GDX, which represent about 57% of the fund's net assets, reveals that the ETF is trading at an implicit projected price-to-earnings ratio in the range of 16.5 to 18.5 for the pure producers. Furthermore, it offers a weighted free cash flow yield between 6 and 8%. These metrics suggest that the market has not yet fully priced in the durability of the current gold price environment or the improved capital discipline of modern mining management. To understand the sustainability of these earnings, we must first look at the structural forces supporting gold at $5,000. This is not a transitory speculative peak but rather the result of two inelastic pillars of demand. First, official sector demand from central banks has shifted from a simple diversification tactic to a national security strategy centered on de-dollarization. Projections suggest net official purchases will remain at high levels throughout 2026, acting as a floor for prices. Second, institutional investors are returning to gold-backed ETFs as a hedge against fiscal deficits and geopolitical fragmentation in regions like the Middle East and South America. Despite gold breaking historic nominal highs, mining shares have lagged. Historically, miners provide operational leverage, where their margins expand faster than the gold price. Throughout 2025, this correlation was temporarily disrupted by concerns over all-in sustaining costs. However, January 2026 marked a turning point. The market is beginning to recognize that while costs have risen, they are increasing at a much slower pace than the price of the commodity. This gap creates a valuation bridge that suggests the GDX has considerable room to move before reaching fair value. The GDX is dominated by a select group of large-cap majors. By aggregating the financial health of these entities, we can determine what an investor is actually paying for. Newmont Corporation, the largest position at over 11%, recently reported annual revenues of $21.5 billion. Their earnings per share for the fourth quarter blew past consensus estimates, marking a fifth consecutive quarter of positive surprises. More importantly, their operating margin expanded to nearly 47%. This confirms that the increase in the commodity price is flowing directly to the bottom line. For every $100 increase in the price of gold, Newmont generates roughly $400 million in additional annual free cash flow. Agnico Eagle Mines, representing over 9% of the fund, continues to be the industry gold standard for low-risk jurisdictions. They reported record free cash flow of $4.4 billion for the 2025 fiscal year. With an all-in sustaining cost of $1,339 against a gold price near $5,000, their gross margin stands at an impressive 72%. This has allowed them to return $1.4 billion to shareholders and increase dividends by 12.5%. Barrick Gold, another major component, saw its free cash flow soar by nearly 200% in 2025. In the fourth quarter, Barrick realized a gold price of over $4,000 against costs of $1,581. This implies a margin of roughly $2,600 per ounce produced. This massive expansion in profitability has allowed Barrick to maintain a net cash position of $2 billion while aggressively buying back shares. The ETF also benefits from the performance of companies like Goldfields and Kinross Gold. Goldfields has transitioned from a high investment phase to a cash harvesting phase, resulting in attributable profits jumping from $1.2 billion to over $3.5 billion in a single year. They are now distributing over half of their adjusted free cash flow to shareholders. Kinross has similarly committed to returning 40% of its free cash flow through dividends and buybacks, reinforcing the theme of capital discipline across the sector. We must also consider the role of royalty and streaming companies like Wheaton Precious Metals and Franco-Nevada, which make up about 10% of the ETF. These companies do not take on direct operational risks or cost inflation. Their business model is based purely on top-line revenue from production. While they trade at higher multiples, usually between 30 and 60 times earnings, they provide a defensive layer and stabilize the free cash flow of the overall GDX portfolio. When we integrate these data points into a weighted valuation model, the implicit price-to-earnings ratio for the GDX is approximately 20.8. While this may seem high at first glance, it is heavily influenced by the premium multiples of the royalty companies. If we isolate the pure mining producers, the multiple sits between 16 and 17. This is exceptionally attractive given the expected earnings growth for 2026. Furthermore, the implicit free cash flow per share for GDX is approximately $6.37. This means for every $100 invested in the ETF at current prices, the underlying companies are generating over $6 in cash annually to support dividends and reinvestment. Looking ahead, three catalysts suggest the current trend has staying power. The first is margin expansion. As Wall Street analysts update their models to reflect sustained margins of over $2,500 per ounce, we expect to see significant upward revisions in consensus estimates. The second is the capital return cycle. Unlike the 2011 peak, where capital was often wasted on destructive mergers, the current cycle is defined by returning cash to shareholders. This attracts a new class of income-focused investors. The third is sector rotation. Most generalist institutional funds remain underweight in mining. Even a minor shift in global capital toward this relatively small sector could trigger explosive price movements. There are, of course, risks to monitor. All-in sustaining costs are still subject to inflation in labor and fuel. If the price of gold were to correct sharply, the impact on margins would be significant. Furthermore, record profits often attract the attention of governments in fiscally fragile jurisdictions, raising the risk of windfall taxes or increased royalties. Finally, mining remains a complex physical business where operational failures or geopolitical shifts can impact individual stock performance. In conclusion, the fundamental analysis of the GDX components reveals a sector that is not just beating expectations but undergoing a structural transformation in profitability. With an implicit free cash flow yield of over 6% and a renewed focus on shareholder returns, the GDX offers a unique vehicle to capture the economic rent of this historic gold cycle. As long as gold remains in this new high-price territory, the cash generation of these miners suggests that the fundamental floor for the sector has moved significantly higher, paving the way for a sustained revaluation.